The last several weeks have been absolutely crazy in the Middle East. Starting in February 28th, the U.S. strikes also with Israel in Iran have really dislodged global oil supply, among other things, and really shifted the whole area and region into turmoil. Today, we're going to talk about what that looks like, what the long-lasting implications are, specifically through the oil lens, because that part of the world is so important, not only for the production of oil and other natural energy sources, natural gas, other commodities, but also the transit of those products between Middle East and Europe and also Asian markets.
Yeah, Hunter, it hasn't just destabilized the Middle East, it's destabilized the entire world. And a lot of that has trickled through to financial markets. I mean, of course, it's really driven by, as you said, oil markets, oil prices. Recently we've seen Brent and WTI soar above 100, above 110. And we're going to get to the point of today's podcast being that we just reached the ceasefire agreement, and we're going to see if that holds, and we're going to talk about the implications. But last time we talked about this conflict, I kind of want to reverse back to how this started, where we were at, kind of provide some context for everyone who maybe didn't see our last episode. And that's the importance of the Strait of Hormuz exiting the Persian Gulf, what that means for oil markets and oil transit, as you said. And the big thing is that strait sees roughly 20 million barrels per day of crude travel through it on a daily basis. And that's about 20% plus of global oil supply. So we're talking about a extremely vital artery in the global oil chain. And that's why this conflict is so meaningful, because it's not necessarily Middle East economics. Those don't really impact the broader global economy. But certainly if you're talking about oil, the Persian Gulf, and oil transit, it's extremely critical. And that's why it's had such a big impact.
Yeah, absolutely. Especially when you consider that oil is something most economies can't live without. 20% of the global oil supply. It's a large chunk, but in a lot of products, you can absorb that. You can offset that with inventories. But in the oil markets, this is a constantly churning thing. And it's not, you can't, draw out those last barrel of oils. People are going to continue to drive, continue to fly, continue to use those products. It's not really an option to reduce your consumption of that in the short term. So that's why we saw such parabolic moves in both WTI and Brent crude oil prices.
Yeah, and it's our job as investment managers, as portfolio managers, to separate the signal from the noise, to really talk about what are the ongoing investment implications. And I certainly want to get to that by the end of this episode. But kind of starting from the beginning of the conflict, we really saw that strait was extremely shut down, essentially no tanker traffic getting oil through that strait. Oil prices, as I mentioned, really ripped. Equities and bonds struggled. Of course, whenever you have this global disruption, your risk premium increases. And so you want a higher return in order to justify any kind of investment, but especially on the equity side, on the stock side. So that led equity prices to decrease. Now, on the fixed income side, on the bond side, it was also interesting because not only did you have that heightened risk premium, but you also had the inflation impact, which trickles through to Fed policy. And we'll kind of circle back on the Fed towards the end of this episode as well. But whenever you're looking at potentially higher inflation from higher oil prices, which trickles through, as you mentioned, to the entire economy, well, that changes the Fed calculus to some extent. If that lasts too long, then you're in a situation where inflation's higher for longer. What does the Fed say about higher for longer? They're not going to cut interest rates. So that's what really led to that, consistent move for both equities and bonds throughout this conflict, especially at the beginning and middle of this conflict. And just a really interesting move in asset prices because you didn't have the flight to safety aspect. You really saw both of those groups kind of trade down together.
Yeah, exactly. There are ton of really interesting underlying market dynamics going on. It felt like a absolutely crazy month and a half there. Although if you really looking at it, the broad indices, S&P and NASDAQ, weren't down all that much all told, usually you're seeing intra-year drawdowns several percent more than this, and this was a very major, economic thing. So it's easy to look back on the last month and a half with, see it as a pretty tough time in markets, but actually in the broad strokes, grand scheme of things, really wasn't that bad. But before moving on to the Fed, before moving on to, where we're currently at, just kind of laying a little groundwork for, where we were over the past few weeks. Leading up to this agreement, it was really interesting to see that, Iran start making deals with a lot of the, similarly aligned Middle Eastern partners, namely Iraq, and, Pakistan, China, all of these countries, China not being there, but being a huge buyer of Middle Eastern oil, because China doesn't produce a lot of their own oil. Right. So pretty much all of that is coming from the Middle East. So you have all of these other countries trying to work deals and getting a few more tankers out of the Gulf. But even then, the Strait was pretty slow for a long time there.
Yeah, you're maybe talking about a few million barrels per day that we're getting through, but nothing super consequential or enough to really change the narrative. Mm-hmm. You did see some interesting strategic moves from countries like Saudi Arabia, who started using their east-west pipeline to reroute a lot of their oil to the Red Sea, and we've seen volumes increase, essentially since the beginning of the conflict, through that pipeline in order to find another route for their crude. So that's helped, relieve some pressure, but Hormuz really remains this vital choke point, and it didn't really look like there was going to be any kind of true alternative, and there still isn't. Now it'll be interesting to see once we get past this conflict, the reinvestment in infrastructure. I'm certain more pipelines will go in to, kind of relieve the, necessity of the strait. But that's where we're at right now. So we didn't really see much relief on oil prices, even as these things kind of continue to develop. A few barrels through the strait, more Saudi Arabian oil in the Red Sea. But regardless, it wasn't making a lot of headway on the issue at large.
Yeah, absolutely. I thought it was really impressive that Saudi Arabia was able to ramp that east-west pipeline you're talking about, because during most peacetime before this, they were transiting maybe 1 million up to 4 million barrels a day through it, but that was not the bulk of their supply at all. And now, for a country that generally produces about a little over 8 million barrels a day, to get 7 per day through that pipeline was a huge win for them, to get that oil to market. But again, that's still, in the grand scheme, a lot of barrels shut down. We saw Iraq even close a lot of production damaged through this conflict. So, it'll take some time to see how much of that and how quickly that can get back online. Yeah,
absolutely. And I think, all of that kind of brings us to today. Last night, we're recording this, on April 8th. And what we saw was a ceasefire agreement be reached between the United States and Iran, with Israel, of course, is a kind of a third party. Lebanon is another additional party as a part of all of this. And it's interesting because there's been a lot of kind of fog of war around the discussion of what a ceasefire looks like, who's demanding what, and which concessions are going to be given. And I think a lot of that has to be fleshed out. But of course, the signaling of the reopening of the Strait was a huge benefit to markets. We saw equities rip, S&P, NASDAQ, both up over 2% today. And just showing that investors were, are ready to buy this market, but they needed to see that the situation was at least moving in the right direction. I think there's a lot to sort out, and we're still not at the end of this. But the ceasefire is certainly a good first step in the right direction of, solving this huge issue for the global economy and getting to a more long-term solution between U.S., Iran, and just the Middle East at large.
Mm-hmm. Absolutely. And everyone's been looking to a ceasefire, as we wrote in our quarterly newsletter that came out a couple days ago. We're expecting some kind of reduction in hostilities. And it looks like, knock on wood, that we actually got some. we have seen a few attacks continue throughout this, but before calling the ceasefire a failure in that point, which I would not do at all, you see this. I've seen this several times throughout, even just my lifetime of people call for a ceasefire. Okay, conflict still trickles on for a day or two, but as long as the major parties involved here continue on their commitment to reduction hostilities, we will get there. And so that's really a word of encouragement that even if you see headlines of a few attacks still going on here and there, that doesn't mean all hope is lost, doesn't mean the ceasefire is necessarily broken, that it just takes some time to get everybody really on the same page. And then, kind of moving on from the ceasefire back to the economic situation. Victor, you want to take us through kind of what that means for the Fed and what they're looking at right now?
Yeah, and I think the Fed reaction is going to be fairly interesting, but I don't think this recent event is going to be too consequential. And kind of taking a step back before diving into the Fed piece, I think this goes along with our conversations and how we've encouraged our investors, our clients to stay the path when it comes to your investment portfolios. There are going to be conflicts like this. I maybe we can throw it up, but there's an excellent chart of all the wars that have occurred over the history of the S&P 500. And of course, this one's bigger than most and has more global implications. But even when you're talking about significant events, I mean, look, a year ago we were in the tariff turmoil stage, and markets have essentially stomached that and come to a better resolution. And it seems that the U.S. administration is focused on markets and is keenly aware of what's happening within the economy, which is a benefit to investors and just staying the course as long-term investors. We've been looking through this conflict, and in a second we'll get to the long-term implications of our portfolios, of the portfolio management piece. But it's really focusing on that long term that I think has been paid dividends at this point. We kind of saw that today in the price action. Now, getting to the Fed piece, as you mentioned, I kind of talked about this at the top of the episode, but the Fed really pays a lot of attention to inflation. And of course, their dual mandate is stable prices, so watching the inflation piece, and then a stable labor market, so watching unemployment. And the unemployment job side has remained fairly stable. I mean, we're looking at kind of that same low hire, low fire environment that we've been talking about really since, last fall. And so the focus has really been on the inflation side of the mandate and what is happening with prices for consumers. And of course, oil trickles through the entire economy. And so I think it's really important that the Fed be watching this, but they're also aware of short-term spikes. They've mentioned this before when it comes to things like tariffs. You're going to see limited time spikes in inflation from some of these events. And in the case of oil, that could be an inflation spike that eventually leads to deflation once oil prices calm. So I think that's what they're thinking about as far as their calculus for future rate movements.
Yeah, I think that's a really good point, that especially drawing the comparison to tariffs, where this is a thing that Jerome Powell and the Fed have been very open about looking through, as they call it, is they know it's a one-time shift up in price level, but that does not mean the same thing as continued inflation, which is continual price increases. And so they're trying to, kind of look through the one-time effects of inflation. And, in my mind, and from the little bit of noise that we've heard out of the Fed in regards to this, it seems like they're going to take a similar tact as far as oil prices go. They're a little bit more difficult, but that's, kind of looking more at core inflation. So excluding your oil, mainly energy in this case, and those really high fluctuating areas, but specifically oil. Some of that will translate into core PCE and core CPI over time. However, like you said, it'll drive deflation when prices return back to normal. So maybe by then it's kind of all simmered out. But realistically, I think they're going to do what they can to look through this and not try and make policy decisions on something that's 6 weeks of turmoil, but perhaps already over.
Yeah, and I think importantly too, we're going to get CPI inflation data point this Friday. That's for the month of March. So that's really the first month where you're going to see some of the impacts of the increase in oil prices. And no doubt energy prices will be up in that CPI print. I mean, that's a foregone conclusion. But whether it's trickled through to anything else, and then what these subcategories are saying about core inflation, as you just said, of services inflation, that's going to be very critical in assessing whether, hey, just because energy is up, these other categories might be trending down, or maybe the opposite. And how is that piece really going to impact the Fed? So, headline inflation, which includes all categories, might be really hot on this next CPI print, but I think it's going to be important to look below the surface as far as what the Fed calculus is going to be from then on out.
Yeah. And so taking that, which may, it may delay some Fed cuts. I don't think it's going to change Fed calculus, but we're also not expecting any additional cuts until the second half of the year anyway.
Right.
So in my view and what I can see from it, I don't expect that to have any tangible impact on the Fed cuts if they're coming in the second half of the year, probably late third quarter, early fourth quarter. They're far enough out to not really be that affected by this, and for the Fed to kind of get their bearings first. But I also want to transition into, given that economic background, what we're doing in the portfolio to, take advantage of the volatility and also our future expectations for the energy markets and what that means for other markets as well.
Yeah, absolutely. And I think kind of the first major point is to do nothing. I know that sounds like counterintuitive, and it's not tactical, but that's the broader strategy is, hey, don't make huge changes to your portfolios and don't sell out of the market, because these are very binary events. We saw that, if you were to have sold out yesterday because you were tired of this conflict, and then all of a sudden ceasefire is announced today, markets are ripping, you don't want to miss the rebound. And I think as long as the fundamental backdrop outside of the oil story still looks healthy, which it does, then you should maintain your investment philosophy, maintain that long-term mindset. And that's really the focus that we've been expressing to our investors, our clients, kind of as I said before in this podcast. But getting to, what are the long-term implications for positioning at especially the stock level, at the equity level? I think one that's going to be really interesting is LNG, so liquid natural gas, and LNG exports, and also just the whole natural gas supply chain. I think because of the damage that was done to infrastructure in the Middle East, you are going to have the United States step in to fill a lot of that volume. And you've had this huge displacement in natural gas prices across geographies because it is not the same as oil. It's not as easily shipped. There's not enough volume to make it a truly global commodity where regional price differences are very, very close when it comes to oil. It's very different whenever it comes to natural gas. So making sure that the U.S. is able to ramp its LNG exports so that it can take advantage of the discrepancy in prices, because you're looking at U.S. gas prices, which typically have been under $4, versus Europe, which is somewhere in the teens type range, versus Asia, which is usually 20 plus. So if you're making the spread between U.S. natural gas and Europe or Asia, that is extremely valuable. You've also just seen LNG export terminals get destroyed in the Middle East. Those are extremely capital and infrastructure intensive, and they're going to take years to rebuild. So that's where we're looking as far as portfolio managers to include more of those LNG natural gas linked equities in portfolios, because it has a longer lasting durable trend compared to the short-term disruption that we've seen maybe just on the oil side of the conversation.
Yeah, absolutely. And I think something you mentioned there at the very beginning was very important about looking at the underlying fundamentals, is that when markets are selling off in a period of stress like this, you have to look at what has actually fundamentally changed. For a lot of companies, nothing. For a lot of the tech names that got sold off pretty hard, nothing fundamentally changed about their business. They're not, doing a whole lot of business in that part of the world. They're not, reliant on oil necessarily. And then, for some companies, the underlying economics have changed, like those LNG shippers that you talked about being a very important piece of this. I think the other piece being predominantly aerospace and defense. We've been talking about this for a while now. Aerospace and defense has, been a priority of the current administrations for a long time. Is a platform point, and now, coming through and actually seeing conflicts, whether it's Ukraine where we're shipping weapons over to it or directly involved expending weapons, the U.S. needs to replace those stockpiles. And all of that is spending that's going to somebody, and it's going to these companies in that area, the ones producing those missiles, because we've seen from a lot of sources that, the U.S. stockpiles already weren't what, the administration would like them to be. And then after being, heavily run through, it could take several years to replenish what was expended in Iran alone.
Right. I think it's going to be extremely dramatic, the amount that's going to be needed to be replenished. And that's going to really trickle to those aerospace and defense companies. We've already seen a global push to ramp defense spending. So not only the U.S., but Europe, and then the Iran war happened and you expended a lot of munitions. So who is that? Who are those additional dollars going to go to? That's going to be those aerospace and defense companies to shore up that production. Somewhat ironically, the defense companies haven't performed extremely well throughout this conflict, but you and I are here to talk about long-lasting, durable trends, and I think that's one that's going to continue. I mean, when we wrote our 2026 outlook and released at the beginning of this year, we cited geopolitical risk as one of our top risk factors to watch. We're seeing that play out in real time right now, and that led us to be invested in aerospace and defense early this year. It's performed extremely well. I think it will continue to do so.
Absolutely. It's hard to do wrong when you have a multi-year order book from a very stable buyer such as the U.S. government.
Yeah, and so I think those are really the two, at least with the positive tailwinds on a long-lasting perspective. It's going to be important to watch oil prices. Of course, industries and sectors that are more consumer oriented are a little bit more sensitive to oil prices. So your consumer goods that have to go through a whole production supply chain have to be delivered to the end consumer. A lot of your consumer staples, those margins get compressed whenever oil prices increase. Of course, things like transportation and logistics. We're just going to have to watch how the oil story plays out. If the ceasefire holds, I think that you haven't seen so much time pass under higher oil environment where you're going to see a lot of margin pressure. But of course, so much of this hinges on, and we'll have to do a follow-up episode about where we are maybe a month or six weeks from now. So much hinges on whether or not the ceasefire holds, and do we get to a long-term resolution?
Absolutely. It's a really important time in history right now and a very exciting time in markets. So appreciate y'all sticking with us through it, and thanks, Victor, for a great discussion.
Absolutely. We just released our Q2 2026 newsletter, our market view. So if you're interested in more insights, you can go to our website at beckcapitalmanagement.com. Check it out. Thanks, Hunter.
Thanks.